session. I'm your host, Chuck Fulkerson. For those of you that I have never had the pleasure of meeting, I am the one of the co-founders and senior trader at tradersarmy.com. Glad you guys are able to join us for tonight's option session. We're going to talk about how we can use options to both grow and protect our portfolio. So I know a number of you are already subscribers and you are trading futures and probably trading currencies, but maybe not as much inside of the options world. So tonight we're going to talk about expanding our horizons into trading options. We're going to look at why we might want to trade options, what they can do for us. And the interesting thing about options, here's the thing that I love. One of the things that I love most about options is that options can, we talk a lot about options from the terms of equity options, right? We talk about stock and equity options, but once you understand how to trade options, then it opens the door to trading things like options on futures, right? It opens the door to trading things on currencies options. You can trade options in other foreign markets. So it really does have a tremendous impact on what it is that you're trading. So looking forward to having a tremendous amount of information handed through tonight. So here's going to be our structure for the evening. We're going to go at most an hour, but please, let's keep this a very, very, very wide open session. I want you to feel free to ask any questions you want. Type it in the chat box. I don't want to just kind of lecture because it's not my thing, but I will go through some foundational stuff in the beginning, give you some examples, talk a little bit about how we can utilize options, maybe show you some different strategies. And we're going to try to keep it really simple tonight because that's one of the things that many people make the mistake of in options is that they tend to overcomplicate things. So what I want to do tonight is not overcomplicate things in the world of options. And then at the end of the session, what we're going to do is we're going to go live into the markets and we're going to look for potential options positions. So we're going to take a look at some stocks that maybe you guys want to look at, and we'll try to build options trades around those positions. Now, we're not going to go too crazy. We're not going to be doing a lot of the multi-legged option strategies, but we will talk about some potential options positions that you guys might be interested in or maybe want to take a look at. So that's the plan and the structure for tonight. So real quick before we get started, one of the things that I always want people to do is to use the chat box. So before we get started, do me a favor, everybody who's in the room, I know it's maybe not something you're used to doing, but I want you all to at least say hello in the chat box and let me know where you're coming from. I know there's a number of you that I recognize from our normal daily market commentaries and our live trading rooms, which today was a phenomenal live trade room, by the way. I hope a lot of you were able to catch that. So let's see. I got William Denton from Yardley, PA. Awesome. Where is Yardley, William? I don't even know where Yardley is. Is that Eastern PA or is that Western PA? I don't think it's Western. Doesn't sound like Western PA. Bucks County. Okay, very good. As a Pittsburgh guy, I didn't think it was. So, hey, Phil, good to see you. Beepaw from Katy. Wonderful. Katy, Texas. And then we've got, let's see, we've got a couple of other. A 2-iron from Trenton. Beautiful. That's always good. Well, maybe your 2-iron. Mine's a little weak. So Marinelle and Stone Mountain, good to have you with us. Great to see you again. And thanks for joining us this evening. Okay. So, Aaron in Topeka. Beautiful. Topeka, Kansas. All right. So let's go ahead and get started. And I want to start with some of the basic foundational concepts around options. So before I get started, how many of you in here would say that you are fairly new, in fact, novices to options, right? Would say that you're fairly new, if not novices to options. Okay, good. Okay. Perfect. So what I don't want to do is overwhelm you because I could quite literally teach options for a month. I could very easily, like if a university came to me and said, hey, would you like to teach options for an entire semester? I could get a semester's worth of content easily. But we're going to try to reduce it to its essence. And the most difficult thing to do is to take a complex take a complex system and make it simple. And that's what I'm going to work on tonight, is see how simple we can make it. So we're going to start with some very basic options definitions and terms and why we might look at options versus stock. Because I'm going to start tonight. I'm going to talk mostly about equity options, right? We're going to talk mostly about equity options, not about futures options. But if you understand equity options, then you can move into futures options, right? So a couple of things to remember. First of all, the reason, and I will tell you, me personally, the reason I looked at options trading was because I didn't have a big account. When I first got started trading, I had a very small account, and there wasn't a whole lot that I could do, right? So since there wasn't a lot that I could do, I decided that, okay, I better figure out a better way to trade, because I saw, my first instructors were showing me all these great trades. Now, by the way, when I first started trading, it was like '05, right? So I started trading '05. So they're showing me these great trades on this stock I'd never heard of called RIM. Anybody remember RIM? They're showing me all these great trades on these stocks, and they're showing, you buy 200 shares at $50 a share. Well, that was more than my entire account was at the time. So I had to have a different way to do it. And one of the great things about options trading is you can start with a smaller account. So by definition, you're putting less capital on the line. And that's one of the things that I think is very important for people to realize. The other one is it can work in all account types. So what a lot of people don't realize is that you can use options in a retirement account. Okay, let me say that again. You can use options in a retirement account. Options can be done inside of an IRA. So if options can be done in an IRA, what that gives you is an advantage over people that don't use options in their IRA. So you're going to want to understand what it is you can do. Now, that's broker specific because not every broker allows that. So you definitely want to check with your broker. One of the things that we'll talk about is that there are what are called 5 levels of options trading. And let me make it really simple, and I'm going to reduce it to the ridiculous. Your broker should at least let you do up to level 3 in your retirement account. So call your broker and ask for authorization level 3, okay, at the very least. And theoretically, you should be able to do even a little bit higher than that, but definitely levels 1 and 2 and 3, okay? Now, we'll explain what 1 and 2 and 3 are a little bit later because I think it's important to know. So they're really great for generating both active short-term and passive long-term income. So when we talk about active short-term income, we're talking about it from the concept of being spread traders, right? I'm sorry, I'm reading the chat box and talking. We're talking about active short-term. We're talking about being swing traders. We're talking about being swing traders, and being a swing trader is an important thing because it allows me to get in and out of markets a little bit faster, right? I want to be able to get in and out of markets a bit faster and take advantage of the swings on market moves. So options are phenomenal for that, especially when I understand how time decay works. But they're also good for passive long-term income, allowing me to generate an income from either the passage of time when I'm collecting what's called time decay, or from longer-term moves and bigger picture chart moves. They're also great for portfolio protection. So the thing to remember about options is what they were created to be. For those of you that are unaware, options were primarily created, right? They were primarily created as insurance policies. They were created as insurance policies designed to protect your portfolio. So we'll talk about what they were created for in a little bit when we get into the definitions of each of the 2 options. They're great as a stock replacement. So instead of trading stock, we're going to trade options. And the examples I show you tonight are primarily going to be stock replacement examples. This is a big one. So we can obtain what's called dynamic leverage with limited and defined risk. So let me explain what dynamic leverage means. So when I look at dynamic leverage, and let me clear this off. Now, I'm going to try to write this out, so hopefully this will make sense to everybody. So let's say that I buy a stock at $50 a share, okay? And the stock goes from 50 to 51. Well, in that case, I have made $1, right? Stock goes from 51 to 52. in that case, I have made $1. Okay. And by the way, all the way up to 53. So what this means, and by the way, stock goes down to 49. In that case, I have lost $1. So when we look at this, we're looking at what is called a delta. The change in stock every time is what? What is our change in stock every time? If we think about this, what's our change every time? Our change is 1, right? Our change is 1 every time, dollar for dollar, okay? Now, since our change is 1 on the stock, we don't have any dynamic leverage. We have no leverage at all. Stock moves up $1, our portfolio moves up $1. That's really no leverage. Now, let's talk about options. So in options, oftentimes in options, let's say that the stock, oops, what is that? Why did that open? Sorry about that. Don't know why that opened. All right, so in options, let's say that the stock is trading at 50, okay? Well, in this case, let's say that my option costs me $2, right? So let's call this the stock, and let's call this the option. Okay, now in this case, it would be what's called a call option. But the stock goes from 50 to 51. The option goes from 2 to 250. Okay, now the option doesn't give me dollar for dollar movement. Stock goes from 51 to 52. The option goes from 250 to 315. The stock goes to 53. The option goes to 4. The stock goes to 54. The option goes to 5, right? Now, these aren't exact numbers, obviously, but the point that I'm trying to make here is notice that every time the stock between here and here, between here and here, every time the stock goes up by $1, it's constant. Well, the option has what's called dynamic leverage. The option for the first dollar movement in the stock goes up by 50 cents. For the next dollar movement in the stock, the option goes up by 65 cents. For the next movement, the option goes up by 85 cents. And for the next movement, the option goes up by $1. Now, at this point, it's not going to get bigger than $1. So what that means is that when I'm right, the more right I am, what happens to my profit when I'm right? If I bought the stock and if I bought the option that I thought was going to go up in value, what happens? The more right I am, the more money I make. Okay? Now, let's take it the other way. Here's where it gets really exciting. Let's say that your stock goes down, change color here, to 49. Well, your option's going to go to $1.50. Stock goes down to 48. Your option might go down to $1. Let's say $1.15. Stock goes to 47. Your option goes down to 95 cents. Stock goes to 46. Okay? Your option goes down. So your option maybe goes down to 70 cents. Now, what I'm looking at here, the difference is on the way down, the first dollar costs me 50 cents. The second dollar only costs me 35 cents. The next dollar costs me 20 cents, right? And I guess this would be more like 80 instead of 95 cents. The next one would cost me 15 cents. I did bad math in my head. For every dollar I'm wrong, what happens to my losses? Think about that for a moment. For every dollar that I'm wrong, type it in the chat box. What happens to my losses for every dollar that I'm incorrect in my position. My losses get smaller and smaller and smaller, and my gains get larger. This is dynamic leverage. It's dynamic leverage. Now, think about this for just a minute. When I talk about leverage, the stock went from 50 to 51. That is a 2% move, right? 2% move. The option went from 2 to 250. In this case, that is a 25% move. Right? Now, that's just this hypothetical example, but the point is that is the difference in leverage. And then for each time it goes up, that percentage will continue to rise. So that is when we talk about dynamic leverage, that's what we mean. And the other side is that we've got limited and defined risk, meaning I can't lose any more than I put into the trade in some of the positions, right? When I'm buying an option, I can't lose more than what I put into the trade. So some interesting things to look at when you come to what options are and how I can use them. So they're good for all market environments. Up markets, down markets, sideways markets. Very strong up, very strong down. Kind of up, kind of down. They're great for any market environment because what happens is I can change my strategy to fit the environment. Okay? I can change my strategy to fit the environment. And I think that's the thing that most people tend to forget about. So, when I think about what these things are, an option, that's the very definition of an option is the option offers the buyer the right, but not the obligation to either buy or sell an underlying at a specific price, which is called the strike price, on or before a specific date, which is the expiration date. Okay? Now, the buyer has the right. The option seller is obligated to either deliver or purchase the underlying if the buyer exercises those rights associated with the contract. Whoa, what does that mean, Chuck? Well, what it means is the buyer pays a premium to the seller in every transaction. So, very simple way to consider it. Very simple way. How many of you out there, those of you that are in the room today, how many of you have car insurance? Okay? You guys have car insurance? If you have car insurance, you already have an option. Okay? If you have car insurance, you already have an option because you have the right to sell your car back to the insurance company, but only if the value of your car does what? What does the value of your car have to do in order for you to be able to exercise that right? Hello, Fahim. Welcome. Yeah, the value of your car has to crash, quite literally, right? So the value of your car has to crash in order for you to be able to exercise that right. So now, but if that happens and your car is totaled, do you have to file a claim? Let's say that you get into a big car accident. Oh, you don't get into a big car accident. A meteor falls from the sky and crashes your car. You have nothing to do with it, right? Keep you safe. Do you have to file a claim? Are you required to file an insurance claim? Nope. There is nothing that says that you have to file a claim in that instance. You have the right, but not the obligation. Now, if you file the claim and the car is totaled, does the insurance company have an obligation to pay you for that car? Yeah. Now, when they pay you for the car, what are they also going to take? They're going to take the car, right? Now, interesting. So I live here in Houston, and we had a lot of people's cars that were totaled during Hurricane Harvey a couple of years ago. In my neighborhood, it's actually kind of humorous now. My neighborhood has like 40% of the cars in my neighborhood are Teslas because everybody got a new car after Harvey. But that's because the insurance company bought their cars. And a lot of them wanted to just get the cash and keep their car. No, the insurance company's not going to do that because they are purchasing the vehicle. So when you think about options, an option is an insurance policy on stock. That's all it is. So there's two types of options. And the option I was just talking about, The option that that I was just talking about was what's called a put option. Okay. Now, a put option in the example that is a put option, which was the car example, the buyer has the right to sell the underlying at a specific price on or before a specific date. Now, this is specifically what's called an American style option. In an American style option, they can do it on or before a specific date. In a European style option, they do it on a specific date. So that is something that is different between American style option and European style options. So the buyer has the right to sell. The seller has the obligation to buy the stock at a specific price on or before a specific date. So this put, the thing I want you to remember about puts, if you're taking notes, is this is insurance for long stock. That's the thing to think about a put. And a put is insurance against long stock. Why would I need to use that insurance? Well, let's look at an example. See, if I buy a stock, let's say that there's a company that has had just gangbuster movements, right? Let's say there's a company that has had absolutely gangbuster market movements, and over the last year, it has done nothing but rally, right? You've got a company that over the last year has done nothing but this. It's just gone up and up and up, and maybe it had a nice pullback to get you back in, but then it's gone up and up and up, and it's gone up over the last year 75%. It's had a huge run, okay? So this company has just gone straight up. And you see that at the top, it's consolidating a little bit. So you decide, you know what I'm going to do? I'm going to buy it when it gets up above here. And you say, okay, I'm going to buy it on a breakout, and you buy it right there. So you buy right here. And you place a stop right underneath there, right? You place your stop right there because you want to make sure that you're protected. So you buy right here. And your stop is right here. And the next day, the company announces earnings. And it goes down and does this. Where do you get out? Do you get out at your stop? What do you think? Do you get out at your stop loss in this instance? Where are you out? No, you're out down here or lower because your stop loss is typically a market order, right? But what if you had said, you know what? I'm going to buy the stock at 140 and I'm also going to buy a 140 put. Now, at the same time that you bought that 140 put, you buy the stock. This put acts as your what? What is this put acting as? Yeah, that put is acting as an insurance policy. That's exactly the way to think about that position, right? So let me give you an example. By the way, those of you that watched the daily or that were in the live trade room this morning, hopefully you were able to catch some of this move that we had in the S&P today. This was a gangbuster move from this morning's room. Anybody catch that today, by the way? Anybody in the room catch that one? So real quick, so here's an example. Let me go to a daily chart. Here's a stock that just recently did that, right? Had a really nice move. Actually came back to an all-time high. Over the course of the last year, it's gone from about 60 to 145. But on this week's earnings report, what happened? Well, the stock collapsed and went from 144. Now it's down at 105. So what happens is on this, even if you had a stop loss underneath the prior day's low, you're out down here. And you think you're out at 130 and you're out at 125. And this is an example of a gap. Now, what if instead, because maybe you had acquired it at the breakout and your breakout opportunity would have said to buy it somewhere in here. What if you'd acquired it at 132 and as it rose up, you said, you know what? I'm going to buy the 140 put, right? Now, if you buy the 140 put, you have the right to sell the stock at 140, no matter how low it goes. So your put goes up in value as the stock goes down in value. Okay? Does that make sense to everybody? Click on a yes, or let me know if that makes sense to you. If that concept makes sense to you, type it in the chat box. Good. So a put is insurance against long stock. That's the way to think about it. Well, what is a call? Well, a call is the right to buy a set stock at a set price on or before a set date. So this was created as insurance for short stock. This is insurance for short stock. So if you short a stock, the way you get in is to sell, you have to buy to get out. So a call option, you have the right to buy. That's what it was created as for insurance. So for insurance purposes, you buy a call to protect a short. You buy a put to protect a long. Okay? Now, that's if you're using it as a hedge tool. What if I'm just using it as a speculation tool, right? What if I'm just using it as a speculation tool? Very simple. If I'm bullish and I think the market's going to go up, I buy a call for the most part. If I'm bearish and I think the market's going to go down, I buy a put. That's the easiest. If all you're doing is buying options, that's the easiest thing to think about, okay? See, the thing to remember about options is that there's only two options. That's it. There's only two, calls and puts. And there's only two actions I can take with those options. I can buy them or I can sell them. And if I remember that, there's only two options and there's only two actions. Two options, two actions. Buy them, sell them. Buy a call, buy a put, sell a call, sell a put. That's it. I got to know which one I use, which one for, right? So ultimately, the thing to remember is this, that when I'm bullish, I can either buy a call or sell a put. When I'm bearish, I can either buy a put or sell a call. Now, what's going to make me do the difference, whether I buy or sell? The difference is going to be what's called volatility, implied volatility. And I don't have enough time today to go into every aspect of implied volatility, but understand that implied volatility is a very important part of everything that we do. And implied volatility essentially means what's the fluff that's put into the pricing of the option. So what we're going to look at today is primarily buy a call, buy a put as a replacement for stock. That's primarily what we're going to look at today because it's the simplest. It's the easiest one for people to grasp. Now, the thing to remember is if I buy to open, I have to sell to close, right? We don't buy options to exercise them. We buy options to sell them. If I buy to open, I sell to close. If I sell to open, I buy to close, right? So when I do this, I can sell a call to open the position. The way I get out of it is that I have to buy it back, right? Or I can buy a put to open a position. The way I get out of it is that I sell it back. Now, when we make that determination, what we're going to do when buying and selling these options, every options trade is going to be based on the stock position. If this, then that. If this, then that. Now, the thing to remember is when I'm buying an option gives me the right, but not the obligation to buy or sell at a specific price. But I only want to make my options decision based on the underlying stock. So let me show you an example of this AMD position. So this AMD position was a trade from our trade feed. Now, this might have been a spread trade, but I've tried to simplify it, and we're just going to look at the call option. So this was a trade, advanced micro devices, that we looked at inside of our live trade room, and we put it onto our trade feed. And the reason that we looked at this level was we had a really nice move outside of this level. We had a little bit of basing, right? A nice little bit of basing in an area that had been tested a number of times. How many of you in here, just real quick show of hands or type it in the chat box, how many of you in here trade breakouts? Let me know if you let me know, do you trade breakouts? Good. Because breakout trading, there is a tremendous amount of opportunity in breakout trading when you see the right moves. So in this one, we had this trade, which had a pretty high probability trade because we had all of the rules that it followed for our breakout. And our breakout rules, for those of you that are not used to our breakout rules, we've actually got a breakout video. But our breakout rule essentially is, has it been touched 3 times? Do I have room to roam? That's the most important things. So we broke out, placed our stop just below. Now, you can buy the stock for $29.96, but if we think the stock is going to go up, in lieu of buying the stock, we can buy the call. Now, the way that you do that is you don't just say, well, buy the call for X amount of dollars. No. The way to do it is to use what are called contingent orders, right? Now, if you caught it on the breakout, you got a really nice move. But here's what's fun about a breakout, right? So what happens if you miss the breakout? What happens if you miss a breakout trade? Typically, if you miss the breakout, what does it still allow you to do? What does it still give you the opportunity to do? Yeah, it gives you the opportunity to trade the reversal, right? So one of the things that we talk about a lot is that there's really 2 types of trades that we look at. We look at breakouts and we look at reversals. So for me, a breakout trade is when I've got price doing something like this, and maybe it's been tested a few times, and I see that I have, let me make this flat. Here we go. And I see that I have a really nice area that we've bounced our head off of a couple of times, and I'm going to use this as an opportunity to get long when we break out above there, right? So that is one style, is to say, okay, I'm going to get long when we break out above here. So one of the things that I like to do is look at a breakout trade as an opportunity. Now, if I miss the breakout, we typically will look at this area, and oftentimes when it breaks out, we have what's called a speed candle. And if we miss the breakout and it results in a speed candle, we then oftentimes get an opportunity to go long on the return, right? So that's a breakout trade. This would be a reversal, right? So I can trade both styles, both breakout and reversal styles, and they're essentially still the same thing, but I understand the rules behind them, right? So in this example, if you miss the breakout, you can still trade it by saying, if we get back to $29.96, I'm going to get long, but I'm not going to just get long. What I do is I use a contingent order that says, if the price of the stock gets to $29.96, then buy the option, right? So we're using a contingent order. Now, depending on what broker you use, they've all got a slightly different methodology for how they do it. In Thinkorswim, it's called an order rules box. In TradeStation, I want to say that it's called the trade activation feature. In Interactive Brokers, it is actually called a contingent order. So every broker's got a different way of doing it. Check with your broker so that you understand how to do it. But what you do is you say, when the price comes back to this area, then we buy the option, okay? So when the stock did come back, so this was when we looked at it on June the 12th, it came back into the area on June the 17th. So on June the 17th is when it came back into the area. Now, at this point, we can buy the stock for $29.96, or we buy the 31 call option as a stock replacement. So in this case, we're looking at the 31 call option. Now, why the 31 call option? I don't have time to dive into exactly why that's the one that we would select, but ultimately what it comes down to is we want to get something that has a delta, right? Now, remember, delta is the rate of change. In a stock, delta is always 1. In an option, we have dynamic deltas, remember? And I want a delta around that 0.5 number. Okay, now there's a number of other rules that we need to look at when it comes to volatility, but now the option, instead of the stock costing me $29.96, the option is going to cost me $3.45. But here's the thing to remember. In a market, and if you're taking notes, write this down. If you're not taking notes, get a pen and write this down, because it was like a light bulb moment when I learned this. You only have control of one thing in a market. That's it. One thing. The only thing you can control in a market is how much you're willing to lose. That's it. You can't control what the market does. You can't control how much you make. You can't control where it goes, how long it goes sideways. You can't control any of that. The only thing I can control is how much I'm willing to lose. Now, whether I'm trading stock, whether I'm trading options, whether I'm trading futures, whether I'm trading forex, whether I'm trading Bitcoin, whether I'm trading rare Norwegian toads, my loss amount is governed by me. Okay? That's something that I really think is important for everybody to remember. So if I'm willing to lose $500 in the trade, I know how to calculate that from a stock perspective, right? Well, from an options perspective, I'm still gonna be willing to lose $500, right? Whether I'm willing to lose 500 in the stock or 500 in the option, the vehicle I trade doesn't really matter, because I want to make sure that I maintain my a constant in what I'm willing to lose, right? Same thing happens in futures. Okay. So when I look at the option, I'm buying it at 345, so I'm paying significantly less, which means I can do what? If I'm buying it for significantly less relative to my number of shares of buying the stock, what can I do? Think about that for a minute. If I'm keeping the amount of money I'm willing to lose constant and I'm buying it for significantly less, what does that mean I can do with the option relative to the stock? Exactly, Eric. That's exactly what it means. It means that you have the ability to buy more options than you would with stock, right? Because remember, the option doesn't move dollar for dollar. The option's not going to move dollar for dollar like the stock does. But I can typically buy more shares of the option than I would of the stock and still have roughly the same loss amount, okay? Now, the stock hits at $29.96. You got the entry at $3.45 a share. Eventually, the stock comes back up and hits its target at $33.15. So what you do is you've got, now we entered the trade on June the 17th. The trade was closed on July the 9th. So at that point, you sell for $4.65 a share. So it's trading for $4.65 a share as it went from entry to target. Now, it chopped around for a couple of days in here, but that's okay. It didn't stop us out, didn't come down to our actual stop loss point. So once that thing closed out, I use another contingent order, right? When I enter the trade, I say, okay, if the stock gets to $33.15, sell the option. And if the stock gets to $28.99, sell the option, right? So I've got the entry, the stop, and the target all preset, right? I've got the entry, the stop, and the target all preset so that I know ahead of time what I'm willing to lose in that position, right? So when eventually, by the way, you can sell that stock here, or you can take it for target 2. And at target 2, it went for $5.55 a contract. Okay, so eventually it went to $5.55 a contract as it went up and hit target 2. And then eventually we did wind up having a target 3. But let's compare these apples to apples, right? So in this example, let's say that you buy 200 shares of stock or buy 4 call options. Well, what would determine how many shares of stock I'm willing to buy? What determines the number of shares I'm willing to buy? How do I determine the number of shares I'm willing to buy? The amount I'm willing to lose. That's exactly right, Brian. 100%, the amount I'm willing to lose. So, by the way, here's the way to think. Here's the way you calculate that in case you've ever wondered. For stock, it's a very simple equation. You take the amount of money you're willing to lose, willing loss, divided by risk, and that gives you position size in the world of stock. Okay, so let's say that let's say that you've got a willing loss of $300, and you've got a risk of 75 cents a share, right? Well, if I take 300 and divide it by 0.75, what is 300 divided by 0.75? It's 400. I shouldn't have needed Siri to tell me that. She's good at that. So this tells me if I'm willing to lose $300, I can do at 75 cents, I can do 400 shares. Now, that doesn't mean that I would do 4 options contracts, because I then need to go look at the option and see how many contracts can I trade if I'm willing to lose $300. And the way that we do that is we use what are called risk graphs. A risk graph will tell us what we're willing to lose. In about 10 minutes, I'll go through a couple of risk graphs and show you, based on what we're willing to lose, how many we could do. In this case, if you're willing to lose, buying 200 shares of stock, you've got a risk of about $314. In the option, you had a risk of $332. So you do 4 call options. So the investment in the stock is $59.92 and the option's at $13.80. Your max risk, $59.92, $13.80, meaning the most I could lose if everything fell apart, right? Now, obviously, we don't expect to lose the most because we've got our stop loss in place. So my stop loss risk, $314 versus $332. The realized profit in the stock was $784. In the option, it's $660. Fairly close in number, but look at the ROI. 13% in the stock versus 48% in the option, right? It's just an overall better use of capital. It's a better use of capital in your position. But the key to remember is you control what you're willing to lose, okay? I'm going to look at a couple more examples, and then we'll go look at some live markets. Here's another one in silver, SLV. So in SLV, we've got an area here. We had an entry down here at 1408 as price comes back into this fair price value demand area, and our target up here at 1560. So this is an ETF, right? So this is an ETF, silver, set up on June the 27th. Price came down into that level. Price came down into that level on the 5th. And so this was a longer term position. We went out to the January 21 options, meaning we plan on staying in this one for a while because frankly, it didn't really move all that much. We didn't think it was going to get up to here anytime soon. We went all the way out to January on those options. So buying the $15 call option was $1.44 a share. So we spent $1.44 instead of $14.08. But this gave us all the way out to the expiration in January of next year because this was a longer term trade. Well, lo and behold, we had a straight up parabolic move in silver, and the trade that we thought we were going to have to be in for months and months and months, well, it made its target in about 20 days, right? Quickly moved up, made its target, and rallied up to that level. So what cost $1.44 to get in is now $2.19 a share. So buy it for $1.44, approach the target for $2.19. Now, if you look based on this position, if you're willing to lose about 200, then in this case, you do 500 shares of stock or 10 call options. So it's an investment of $7,000 versus an investment of $1,400. Realized profit $755 in the stock, $750 in the option, but your profit of $750 is against $1,440, right? Your ROI is 10.7% in the stock, 52% in the option. It's 5 times the ROI on 80% less investment. Okay. Eric has a great question. So Eric's question is, what's a good time period when choosing expiration days? So the important thing to think about here, Eric, is how long do you plan on staying in the trade? That's the thing to consider. If you're only going to be in the trade for like a day, if it's a day trade, or you're going to be in the trade for a week, you don't have to go out 90 days. You might go buy a 60-day option or 45-day option. If you're going to be in the trade for 2 months, well, I want to go out probably at least 4 months on the position, right? I don't want to hold it inside of a certain period of time. And that's one of the things that gets a little bit more in depth. But I definitely, it really bases on how long I plan on staying in the trade. Last one on these examples. So real quick, ABBV, price, short stock. This was a short stock or buy a put option as the stock breaks down below this fair price demand area. So we've got this set up. The stock is $72.19. The 70 put option was $2.50, right? A much lower cost entry, and this was on June the 8th. So price broke below our line of support, broke through that area of support, that demand area, and continued to move down to its target. Now, this was a short opportunity, and you buy to cover the stock at $67.19, or you just sell that 70 put for $4.20. Remember, you bought it for $2.50, you sell it for $4.20. So this is a down position on a breakdown. So on this one, take a look. 7,219 on 100 shares of stock, or I can do 3 call options. Similar level of risk at our stop out position. Same reward, but roughly a 10 times higher ROI. And, oh, by the way, and this is 3 put options, not 3 call options. Sorry about that. This is 3 put options. I can do the option in an IRA. I cannot short the stock in an IRA. Okay? That's an important thing to remember. I can do the option in an IRA. I cannot do the stock in an IRA. Does that make sense to everybody? Very good. Okay. So what I want to do is I'm going to go through a couple of live examples, and hopefully you guys have some stocks in order for me to really use. But a couple of things I want you to take away from this. First of all, some of the takeaways. What's the only thing that I can control in a market? Come on, get your fingers ready. Type it into the chat box. What's the only thing I can control in a market? Exactly. The amount of money that I'm willing to lose. And that's the key to remember when it comes to position sizing. My position sizing is super, super important. Okay. So the only thing I can control is the amount of money I'm willing to lose. And that's how I position size in here. And notice that I'm able to enter the same trade with a lot less capital, right? With a lot less capital to get into the position. I use 80, sometimes 90% less capital, but I get oftentimes 10 times the rate of return. And that's where it starts, is understanding how much you're willing to lose. So options can be a very long, it's something that a lot of people really, really want to understand a lot more about, and what to do with their options positions, because this is just buying a call and buying a put. This is the simplest option strategy that there is available. And one of the things that's important is that you don't get into options unless you understand how to do them. So I know a number of you in here are already Traders Army subscribers. So if you have not already watched it, if you go underneath at the website, if you go underneath the Learn tab, there are we've probably got 20 hours worth of options curriculum that starts with foundations. So begin with options foundations. The options foundations course is, what is an option? Premium calculation, liquidity, volatility, options Greeks, everything as far as the foundations of options to get you in and get you started. And then it gets into more strategic options trading, specifically around how to use what are called spreads. So this is the self-paced content that you guys that are already subscribers have access to anytime you want to get to it. So if that's something that you guys that are already subscribers would like to get into, make sure you get in, watch them. If you've got questions, reach out to us and we'll do our best to help you. If you're not a subscriber, do me a favor. You can, if you go to use promo code Trader60, you get 60% off your first month's membership. Give it a try. See if you like it. I mean, just this position, some of these positions alone were trades. These were trades that were taken in our live trade rooms. Set up and done in our covered in our live trade rooms, which is typically done on Sunday nights for options, and then shown in our trade worksheet with our trade update page. Now, if you want a little bit more hand holding, I know some people want some more hand holding. We've got an options trading intensive class. That's live online, September 9th to the 12th. If you think that you want more than just the self-paced on-demand content, if you want that interaction, it'll be very similar to a style like this. You can enroll by August the 15th. Normal tuition on that is $2,500. You save 20% and get it for $19.95. If that's something that you think that you want to do, it's going to be 3 evening classes, and then the 4th session is actually going to be a lab the whole time. So, if one of these makes sense, we'd love to have you as a member. And then if you think you want a little bit more hand holding, you can jump in on the options trading intensive. So go to tradersarmy.com and you can get all that information. All right. I'm going to go and take a look at a couple of live positions. Any questions on what we have covered so far that I haven't addressed as of yet, as we go in and take a look at a couple of live positions? Any questions so far? Because I want to be able to build a few trades and give you some examples and ideas. All right. You guys are awful quiet out there tonight, so no problem. So let's look at a couple of, excellent. I'm glad D likes it. Beautiful. So let's look at a couple of ideas. Let's see. Joe is asking about Facebook. So let's go look at Facebook. Now, when I look at Facebook, let me delete all of my, I'm just going to get rid of all of my old drawings. Remove drawings, clear the drawing set. All right. So let's look at Facebook and let's look at an opportunity. Now, when I look at options, one of the things that we do when identifying options trades is I want to find trades that are in the right volatility range. So what is our volatility range? Well, we've actually got on the website, you can download it. It's a custom indicator that shows the IV range. And when I want to do this, I want to use the implied volatility in the lower 20%. I mean, all we've really done is taken our implied volatility and put in some areas to kind of see where we would be buyers and sellers. And right now I'm in the lower 20%. So that means I could simply buy a call or buy a put, right? I could simply buy a call or buy a put on this position if I decide I want to get into it. So let's look at Facebook. So when I look at Facebook, the first thing that I do is if I go to the big picture, my big picture trend is definitely up. If I'm using the weekly chart as my big picture trend is definitely up. And we've come down into an area that could be a bit of a demand zone, right? So let's go to a daily chart. Yeah, we're a little bit here in the middle, but we're coming up off the bottom. So I'm okay just getting on the call if I think it makes sense. Now, I'm not at all. Not in love with this level one bit. The reason I don't love this level from an analysis perspective, right? If I'm just looking at it from a straight analysis perspective, is that this level, we came out of it, we based a little bit, and then came out again. It's a little bit of a retest of this level, and I don't like the selling pressure of these upper wicks as price is still coming down. Does that make sense to everybody? All right. I don't like the selling pressure as that price is falling. So that tells me that this level of demand is definitely not one that I'm going to be willing to jump on, right? So I'm going to go a bit lower. In reality, I think my best area of demand is this gap fill area. Now, I can't just use this, which is technically a Harami candle. I've got to go all the way to this lower wick down here. and I'll wrap it around the top of this candle's wick. So that would be my zone, 178.14 by 172.61. Now, if that price continues to fall, more than likely my volatility is going to get a bit higher, and I won't be able just to buy the call option. Okay? You said I've got speed candles in the 1 hour time frame. Let's go to the 1 hour time frame. Oh, yeah. So theoretically, I mean, you are. So Joe, are you looking at shorting it somewhere up in here? Looking it up here for a potential short. So I think that's a potential as well. No doubt that that's a potential. You'd actually want to wrap it around this whole area here. It's against the big picture, which is definitely a little bit scarier, but I would be frankly okay with it at this time. So let's say that you decide to take that trade. For the sake of conversation, what we're going to do now is we're going to build this trade as if you're getting into it now, just to look at position sizing. So somebody give me an amount of money. Just type in a number. I don't care what number you type in. An amount of money you might be willing to lose in a given position. Somebody type in, give me a number. And you can't put 0, because if the answer is 0, you shouldn't be doing this. Okay, $500. Perfect. Whether it's 500 or 200, totally irrelevant. Okay? We can do it on both. So let's say that you were trading the stock. Now, if I was trading the stock, what I would do is I would have an entry at about 196.58 and a stop at about go to my hourly chart here again. So an entry at 196.58 and a stop at 198.39. $196.58. Stop at let's do, I like 198.52. That's not so bad. So what's my risk in this position? So my risk in this position is the difference between the two, which would be, what is that? $1.96? $1.96. So my risk is $1.96. So what's my position size in the stock? Well, I've got to take the 500 divided by $1.96. That's how you calculate the your position size. What is 500 divided by 1 point? What is 500 divided by 1.96?
It's about 255.102.
Siri is amazing. So if I'm willing to lose $500, I could do 255 shares. Now, if I'm only willing to lose $200, what is 200 divided by 1.96?
That would be about 102.0408.
So I could do 102 shares, right? That's how you calculate the amount of money that you're willing to lose. So in the stock, I would do 255 shares. Now, what is 255 times 196.58?
The answer is 50,127.9.
So the stock is going to cost me $50,120. It's going to tie up $50,127 in my account if I'm willing to lose $500 in the position. Okay? So how do I calculate in the option? How do I do that same thing in the option? So in the option, what I do in order to calculate that is I've got to use what's called a risk graph. Okay? So we're going to use a risk graph. Now, what I would do is I would go to the Analyze, what's called the Analyze tab, and I'm going to put in our Facebook trade. And let's just say this is more of a swing trade position that we're going to be in it for a few days, but not for very long. So let's go to the September option. Now in that September option, I'm going to look, calls are here on the left, puts are over here on the right, and in the middle is what's called the strike price. So where you see the color change is roughly what's called at the money. So in this instance, I would probably buy the 190 put. Going to cost me $6.60 per share. Now, when I go to this thing here called the risk profile, Where was my stop loss on the stock? Anybody remember my stop loss number? What was my stop loss number? 198.52. Very good, Eric. So what I'm going to do is I'm going to draw a line at 198.52. That's about as close as I'm going to get. I keep missing it. All right. Actually, I can put it at exactly the right number. 198.52. Okay. So now I've just identified at 198.52 what my loss would be. So on one contract, now I'm not going to hold this all the way to expiration. That's something to consider. This blue line is the value at expiration. What I need to do is look and see if I'm only going to be in this trade for a few days, what's it look like? Let's do 15 days from now. So 15 days from now, which is the blue, if I do, and 15 days from now, that's holding it for about 3 weeks. I'm losing $346 in the position. So if I do 2 contracts, I'd be losing $700 in the position at my stop loss point. Now, where am I getting that number? Where I'm getting that number is from this area right over here. Okay, everybody see that area I'm putting stars on over there? That's where I'm getting that number. Okay, so what I do is I look at this area here, and when I go over a price, that area there will change. So coming back over here, what I can see is that number on the blue is 702. So that's more than I'm willing to lose. So 2 contracts, I can't do them. I can only do 1 contract. So on 1 contract, if it goes against me, I'm risking about $344. But I'm only going to spend $660 to get into this trade, right? So trading the stock, it's going to cost me about $50,000. In the option, I can do it for $660. What do you think? Makes more sense to do the option? All right? That's the important part. That's what I want to do, is use an option whenever it becomes, and it just makes a lot more sense. I'm able to protect my portfolio, use a lot less of my capital, and get better returns. And when we look at options trades, we analyze it using what's called the risk graph. So whether you take our live online options course, or whether you do the on-demand content that's as a subscriber, you're gonna understand risk graphs. If you don't understand risk graphs and you're already trading options, you need to learn, right? Just these examples alone, hopefully, are enough. Just these examples that we covered tonight, and these are all trades that happened in the last, I don't know, month or so. Just these examples alone, hopefully, are enough to at least get you thinking about trading options in the future. So with that being said, I'm gonna leave this up here. If you are interested in joining Traders Army, you get 60% off your first month's membership. Promo code Trader60. If you want to take the live options course, certainly you're welcome to take it. You get lifetime retakes whenever we have the course. So it's a one-time investment. You'll be able to retake it. But that is all that I have for this evening. I want to open it up for questions. If you have any questions at all, hopefully you guys, if you don't trade options, hopefully you learned something new this evening. And if you do trade options, hopefully it was at least eye-opening on maybe something else that you don't do. So questions before I log this thing off. All right. Well, I'm going to shut this thing off. If you want to learn a bit more, certainly go to tradersarmy.com. We are here to help you do the best that we can. Our email address, I'll type it in the chat box, is support@tradersarmy.com. If you are not a regular subscriber, feel free to join us there. And if not, then at the very least, watch us on the daily market commentaries. But thank you guys so much for coming in this evening. I hope you had a great night, and I appreciate you all. Thanks. See ya.